A Beginner's Guide to the Stock Market by Matthew R. Kratter. Introduction. Imagine a man named Ronald Read. He wasn't a Wall Street wizard or a tech mogul. For most of his life, he worked as a gas station attendant, and later, as a janitor at a J.C. Penney department store. He lived a quiet, simple life. He drove a used car, used safety pins to hold his coat together, and was known around his small town as a friendly, frugal man. When he passed away at the age of 92, his community was stunned to learn his secret. This humble janitor had quietly built an $8 million fortune. How did he do it? There was no lottery ticket, no inheritance. Ronald Read's secret was something far more powerful, a machine accessible to every single one of us. He simply took what little he earned, and for decades, he consistently invested it into the stock market, specifically in companies that paid him back, year after year. His story is the quiet, powerful truth at the heart of the book we're exploring today, A Beginner's Guide to the Stock Market by Matthew R. Kratter. Kratter, the founder of Trader University and a man with over 2 decades of experience in the financial world, including time at hedge funds, wrote this book for a simple reason. He believes the stock market is the greatest opportunity machine ever created, and it shouldn't just be for the rich and privileged. It should be for everyone. For the janitor, the student, the young person just starting out. But for many of us, the stock market feels like a distant, walled-off city. It's spoken of in a language we don't understand, of bulls and bears, P/E ratios and moving averages. It seems impossibly complex, a place where you can lose everything in the blink of an eye. Kratter's mission is to give you the key to that city. To tear down the walls and show you that with a little knowledge and a lot of discipline, you don't just have to survive in that city, you can thrive. So, for the next little while, I want you to forget everything you think you know about Wall Street. Forget the shouting men in suits and the frantic, flashing numbers on the screen. Today, we're going to do what Ronald Read did. We're going to start small. We're going to learn the simple, powerful secrets that can turn small beginnings into great wealth. By the end of our time together, you will not only understand what a stock is and how the market works, but you will also have a clear roadmap of the different paths you can take. Whether you want to build your fortune slowly and steadily, or take a more active, strategic approach. This isn't just about money, it's about understanding the engine of our modern world and learning how to harness its energy for your own life. Book summary. Let's begin with the most basic question of all. What exactly is a stock? Forget the jargon for a moment. Matthew Kratter asks us to imagine that a company, let's say McDonald's, is a giant pie. A stock is simply one slice of that pie. When you buy a share of McDonald's, you aren't just buying a little piece of paper or a number on a screen. You are becoming a partial owner of the company. You own a tiny fraction of every restaurant, every deep fryer, every golden arch around the world. If you had enough money, you could buy up every single slice, and you would be the emperor of burgers. The price of one of those slices, what we call the stock price, is constantly changing. Why? Because all day long, millions of people and powerful computers are processing new information and collectively deciding what the entire pie is worth. If McDonald's invents a revolutionary new burger that everyone loves, the pie becomes more valuable, and the price of each slice goes up. If they have a terrible quarter, the pie shrinks, and the price goes down. This total value of the pie is called the market capitalization or market cap. It's just the price of one slice multiplied by the total number of slices. When you hear that Apple became the first company to be worth over $1 trillion, this is what they're talking about, the total value of its entire pie. But here is the most important secret to understand about the market. It's what the legendary hockey player Wayne Gretzky meant when he said, "I skate to where the puck is going to be, not to where it has been." The stock market does the same thing. It's a forward-looking mechanism. It's always trying to price in what will happen in the next 3 to 6 months. This confuses so many beginners. A company might announce fantastic earnings, that it made a ton of money last quarter, and yet, the stock price falls sharply the next day. Why? Because the market isn't looking at the past. It heard something in that announcement, perhaps a warning from the CEO about future challenges, that suggests the puck is heading toward a less profitable part of the ice. The market is already skating there. Your job, as an investor, is to learn to think like Gretzky. So, how do you get into the game? How do you actually buy your first slice of pie? You can't just walk onto the floor of the New York Stock Exchange. You need a middleman, called a broker. Today, this is incredibly easy. Companies like Robinhood, Charles Schwab, or Fidelity allow you to open an account from your phone, move some money in, and you're ready to go. Kratter points out that brokers like Robinhood even allow you to buy and sell stocks without paying a fee, or a commission, which is a game changer for beginners. Once your account is open, you have a crucial choice to make. When you go to buy a stock, you'll be asked if you want to place a market order or a limit order. This choice can save you a lot of grief. A market order tells your broker, "Get me this stock right now, I don't care about the exact price." A limit order says, "I am only willing to pay this specific price or less for this stock." Why does this matter? Because for every stock, there's a bid price, what buyers are willing to pay, and an ask price, what sellers are willing to accept. The gap between them is the bid-ask spread. For a popular, heavily traded stock like Apple, that spread might be just a single penny. Using a market order is usually fine here. But for a lesser-known, illiquid stock, the spread could be huge. Imagine the bid is $50 and the ask is $52. If you place a market order to buy, you'll get filled at $52. If you immediately change your mind and place a market order to sell, you'll sell for $50. The stock didn't even move, and you've already lost money. Kratter's advice is clear. Until you're an expert, almost always use limit orders. It protects you from these hidden costs and from sudden price spikes. Now that you have your brokerage account and you know how to place an order, the million-dollar question arises: what should you buy? For most people just starting out, Kratter suggests the safest and simplest path is to not try to pick individual stocks at all. Instead, you can buy the entire haystack, rather than searching for the needle. You do this by buying an index. An index is just a basket of stocks. The most famous one is the S&P 500, which is a basket containing the 500 largest and most influential companies in the U.S. Trying to buy all 500 of those stocks yourself would be a nightmare. Luckily, there's a brilliant invention called an ETF, or exchange-traded fund. An ETF is a single stock that represents an entire index. So, if you want to own a piece of all 500 companies in the S&P 500, you just buy one stock. The ticker is SPY. If you're more interested in big tech companies like Apple, Google, and Amazon, you can buy the NASDAQ 100 index through its ETF, which has the ticker QQQQ. This strategy is called indexing, and it's a form of passive investing. You aren't trying to be clever or outsmart the market. You are simply accepting the average return of the market as a whole. And for most people, that's a fantastic strategy. To make it even more effective, many people use cost averaging. This just means investing the same amount of money every month, say $100. When the market is high, your $100 buys fewer shares. When the market dips, your $100 buys more shares. Over time, this smooths out the bumps and gives you a good average price. Buying an ETF like SPY and holding it for 30 years is one of the most reliable ways to build wealth. But maybe you want a more direct connection to your investments. Maybe you want to be more like Ronald Read, the janitor millionaire. That brings us to the second path: dividend investing. This was Ronald Read's secret weapon. Some companies, usually older, more stable ones, choose to share their profits directly with their owners, the shareholders. These payments are called dividends, and they are typically paid out every 3 months. When you own a dividend stock, cash just shows up in your brokerage account, whether the stock market is up or down. It's like owning a tiny rental property, but you never have to fix a leaky toilet. The real magic happens when you take that dividend cash and use it to buy more shares of the dividend-paying stock. Those new shares then pay you even more dividends, which you use to buy even more shares. It creates a snowball of wealth that grows larger and larger over the years. This is how Ronald Read turned a janitor's salary into an $8 million fortune. The best dividend companies don't just pay a dividend, they raise it every single year. A special group of elite companies, called dividend aristocrats, have raised their dividend every year for at least the last 25 years. These are household names like Coca-Cola, Johnson & Johnson, and McDonald's. You can even buy a basket of all the dividend aristocrats through an ETF with the ticker Noble. Owning companies like this is one of the surest ways to know you're investing in a healthy, profitable business. After all, a company can't send you real cash every 3 months if it isn't making real money. This leads us to the third path, the one championed by the most famous investor of all time, Warren Buffett. His strategy seems deceptively simple. Find a wonderful company, buy it at a fair price, and then hold it for decades. The hard part, of course, is figuring out what makes a company wonderful and what price is fair. Buffett's secret lies in identifying businesses with what he calls strong pricing power. Pricing power is the ability to raise prices without losing customers. Think about it. If your local gas station raises its price by 10 cents, you'll probably drive across the street to its competitor. It sells a commodity. But when Apple raises the price of the new iPhone, people line up around the block to buy it. When Coca-Cola costs a little more, you probably don't even notice. That's pricing power. As Buffett says, if you have to have a prayer session before raising your price by 10%, you've got a terrible business. So how do you invest like Buffett? Kratter offers a brilliant shortcut. Just copy him. Every year, Buffett's company, Berkshire Hathaway, releases a letter to its shareholders, and in that letter is a list of every major stock he owns. You can literally look at his portfolio, stocks like American Express, Apple, Bank of America, and of course, Coca-Cola, and build your own. An even easier way is to just buy shares of his company, Berkshire Hathaway ticker BRKB, and let the master himself do all the hard work for you. Now, these first 3 strategies, indexing, dividend investing, and the Buffett way, are all part of a philosophy called investing. It's about buying and holding for the long term. But there's another world, a faster-paced world, called trading. Traders hold stocks for shorter periods, months, weeks, days, or even just a few hours. Kratter emphasizes that one is not better than the other. They are just different tools for different goals. Let's explore a few of the traders' tools. Many new traders get lured into what's called value investing, which at its core means buying something for less than it's worth. This often gets misinterpreted as simply buying stocks that look cheap, specifically, stocks with a low price-to-earnings, or P/E ratio. The P/E ratio just compares a company's stock price to its earnings. A low P/E might suggest a stock is a bargain. But Kratter issues a stern warning. For beginners, stocks with very low P/E ratios are almost always a trap. They are usually cheap for a reason. These are often companies with huge debts, outdated products, or falling revenues. He gives a perfect example. In 2009, you could buy shares in the video rental company Blockbuster at a super low P/E of 2. It looked like a steal. Or, you could buy shares in a newer company called Netflix at a much more expensive P/E of 26. Which one was the better investment? Blockbuster was cheap because its earnings were about to completely disappear. Netflix looked expensive, but its earnings were about to explode upwards. Buying cheap stocks that are on their way to zero is never a good deal. This is the value trap. A much more powerful strategy for traders, Kratter argues, is to focus on growth stocks. These are companies that are rapidly growing their revenues and earnings. And the first rule of trading them is to completely ignore the high PE ratio. Great, fast-growing companies almost always look expensive. Amazon traded at a very high PE for years, but it made its long-term shareholders incredibly wealthy. So how do you trade these rocket stocks? Kratter's approach is counterintuitive but powerful. He likes to buy growth stocks when they are hitting new 52-week highs, or even all-time highs. This seems scary to most people. Isn't it risky to buy a stock at its absolute peak? But think about the psychology. When a stock is at an all-time high, every single person who owns it has a profit. There are no frustrated investors waiting to sell their shares just to get their money back. The only people who are in pain are the short sellers, traders who bet the stock would go down. As the stock climbs higher, they are forced to buy back their shares to cut their losses, which adds even more fuel to the fire, pushing the stock even higher. To do this safely, he uses simple technical guides. He only buys a stock if its price is above its 50-day moving average, and the 50-day moving average is above the 200-day moving average. This is a simple visual check to confirm the stock is in a healthy uptrend. A growth stock in a downtrend is one of the most dangerous things in the market. An even more volatile arena for traders is the world of IPOs, or initial public offerings. This is when a private company first offers its shares to the public. There's often a lot of media hype around big IPOs like Uber or Facebook. But Kratter warns that an IPO is often a giant transfer of wealth from the dumb money regular people to the smart money the company founders and early investors. The insiders are cashing out, and you have to ask yourself why they are selling if the company's future is so bright. The nature of IPOs has changed too. Amazon went public just 3 years after it was founded, with a small valuation of around $438 million. This allowed public investors to ride its incredible journey to becoming a trillion-dollar company. By contrast, Uber stayed private for 10 years, and went public with a massive valuation of over $80 billion. Most of the explosive growth had already happened while it was private. For traders, however, the small number of shares available after an IPO, what's called a small float, can create huge volatility, and therefore, huge opportunity if you have a disciplined strategy and a strict stop-loss. Finally, Kratter shares one of the most intriguing strategies in the book, a way to make money from a stock that is going absolutely nowhere. Let's say a stock has been stuck in a range, trading between $45 and $50 for months. You can use a strategy called a covered call. The mechanics are a bit more advanced, but the concept is simple. You buy 100 shares of the stock. Then, you sell someone else the right but not the obligation to buy your shares from you at a slightly higher price, say $50, by a certain date in the future. This is called selling a call option. For selling them this right, you get paid a cash premium upfront. If the stock stays flat or goes down, it never reaches $50. The option expires worthless, and you just keep the premium you were paid, plus your original shares. It's a way to generate income from stocks that are just bumbling along. Whether you choose the path of the long-term investor or the short-term trader, your success will ultimately depend not on picking the perfect stock, but on avoiding critical mistakes. Kratter concludes his guide with what he calls the 5 commandments for beginners, 5 rules to write down and put on your computer screen. First, don't buy stocks that are hitting 52-week lows. Trying to catch a falling knife is a recipe for disaster. Bad news comes in clusters, and there is never just one cockroach in the kitchen. Second, don't trade penny stocks. These are stocks that trade for under $5, and they are a minefield of fraud, poor quality companies, and extreme volatility. You are far better off buying one share of a $100 stock than 100 shares of a $1 stock. Third, don't short stocks. Shorting is betting that a stock will go down. It's an advanced strategy for a simple reason: your risk is unlimited. If you buy a stock, the most you can lose is what you invested. If you short a stock, it can theoretically go up forever, and your losses can exceed your entire account balance, putting you in debt to your broker. Fourth, don't trade on margin. Margin is just borrowing money from your broker to buy more stock. It's a form of leverage, and it amplifies everything. It doubles your gains when you're right, but it doubles your losses when you're wrong, which can wipe out a new trader very quickly. And the fifth, and perhaps most important commandment: don't trade other people's ideas. A hot stock tip from your neighbor or something you see on TV is useless. Even if the idea is good, you won't have the personal conviction to hold on to it when things get tough, because you didn't do the work yourself. True financial freedom comes not from being given a fish, but from learning how to fish for yourself. Commentary. As we step back and look at the landscape Matthew Kratter has painted for us, the overwhelming feeling is one of empowerment. The stock market, so often portrayed as an exclusive casino for the elite, is revealed to be something else entirely: a tool. A powerful tool for wealth creation that is, in this day and age, available to anyone with a smartphone and a little bit of curiosity. What I find most profound about Kratter's message is its deep respect for individuality. He doesn't prescribe one single right way to succeed. Are you patient, risk-averse, and content to build wealth slowly and quietly like Ronald Reed? Then dividend investing or indexing is your path. Do you have a knack for identifying future trends and a tolerance for risk? Then perhaps growth stock trading is for you. The book's central philosophy is that success in the market comes from a kind of self-knowledge, finding the strategy that aligns with your own psychology, your own timeline, and your own tolerance for risk. The most actionable and perhaps life-saving part of this guide is the final section on the 5 huge mistakes that beginners make. These 5 rules are the guardrails on the highway to financial independence. They won't guarantee you'll reach your destination, but they will dramatically reduce your chances of ending up in a ditch on the side of the road. The warning against catching a falling knife by buying stocks at 52-week lows is a lesson that has saved disciplined investors fortunes, while ignoring it has cost emotional investors just as much. It's a simple, powerful reminder that in the market, what is popular is often profitable, and what is cheap is often cheap for a very good reason. So, where do you go from here? The journey from small beginnings to great wealth doesn't start with a giant leap. It starts with a single, manageable step. Here are a few you can take today. First, open a brokerage account. You don't even have to fund it right away. Just go through the process. Demystify it. See that it's not some exclusive club. Second, when you are ready, put a small amount of money in, an amount you would be completely okay with losing, say $50 or $100. Use that money to buy one share of an ETF like SPY. Just one. Feel what it's like to be an owner of the 500 biggest companies in America. Watch it move, not with fear or greed, but with curiosity. This single action will teach you more than a dozen books. Third, pick one strategy from this book that resonated with you and just start learning more about it. Was it the idea of dividend aristocrats? Google the list. Read about those companies. You don't have to invest a dime, just begin the process of learning to fish for yourself. That was a summary of A Beginner's Guide to the Stock Market by Matthew R. Kratter. We've touched on the core ideas today, but a summary is like looking at a travel brochure. It can show you the beautiful pictures and tell you about the destinations, but it can never replace the feeling of actually taking the journey yourself. The real value of this book is in the clarity and simplicity with which Kratter explains each concept, turning what feels complex into something you can truly grasp. This summary is your map, designed to help you decide if this is a journey you want to take. If anything we've talked about has sparked your interest or made you feel that maybe, just maybe, this world isn't as intimidating as you thought, then I encourage you to pick up a copy. Reading it isn't just about learning, it's about taking that first, crucial step toward your own financial future. And if you found this exploration valuable, I'd be grateful if you'd hit that like button and subscribe to the channel. That way, you won't miss our next deep dive into another life-changing book from the billionaire's bookshelf. Let's keep learning, and let's keep growing, together.